Hello everyone, welcome back to the channel. In the previous video, we explained the key concepts of financial ratios. Now, in this video, we're going practical. We're going to calculate real financial ratios step by step using example IFRS-based financial statements. So get your calculator ready and let's begin. Example company financial data, IFRS-based. Assume the company reports the following. From the statement of financial position, current assets equals 500,000. Inventory equals 120,000. Current liabilities equals 250,000. Total assets equals 1,200,000. Total liabilities equals 700,000. Shareholders' equity equals 500,000. Trade receivables, beginning, equals 80,000. Trade receivables, ending, equals 100,000. Inventory, beginning, equals 100,000. Inventory, ending, equals 120,000. From the income statement, revenue equals 1 million. Cost of sales equals 600,000. Gross profit equals 400,000. Net profit equals 150,000. Profit before interest and tax equals 200,000. Finance cost equals 40,000. Market information, number of shares equals 100,000. Market price per share equals 15. Now let's calculate each ratio. Liquidity ratios, current ratio. Formula, current assets divided by current liabilities. Equals 500,000 divided by 250,000. Equals 2.0. Interpretation, the company has 2 times more current assets than current liabilities. This indicates strong short-term liquidity. Quick ratio, formula, current assets minus inventory, divided by current liabilities. Step 1. 500,000 minus 120,000 is equal to 380,000. Step 2. 380,000 divided by 250,000 is equal to 1.52. Interpretation. Even without selling inventory, the company can still cover its short-term debts. Profitability ratios. Gross profit margin. Formula. Gross profit divided by revenue. 400,000 divided by 1 million is equal to 0.40 equals 40%. Interpretation. The company keeps 40% of revenue after covering production costs. Net profit margin. 150,000 divided by 1 million is equal to 0.15 equals 15%. Interpretation. For every 1 currency unit of revenue, 15 cents becomes net profit. Return on assets. Net profit divided by total assets. 150,000 divided by 1,200,000 is equal to 0.125 equals 12.5%. Interpretation. The company generates 12.5% return from its assets. Return on equity. Net profit divided by shareholders' equity. 150,000 divided by 500,000 is equal to 0.30 equals 30%. Interpretation. Shareholders are earning 30% return on their investment. That is very strong performance. Efficiency ratios. Inventory turnover. Formula. Cost of sales divided by average inventory. Step 1. Calculate average inventory. 100,000 plus 120,000 divided by 2 is equal to 110,000. Step 2. 600,000 divided by 110,000 is equal to 5.45 times. Interpretation. Inventory is sold about 5 times during the year. Receivables turnover. Formula. Revenue divided by average receivables. Step 1. Average receivables. 80,000 plus 100,000 divided by 2 is equal to 90,000. Step 2. 1 million divided by 90,000 is equal to 11.11 times. Interpretation. Customers pay about 11 times per year. That indicates efficient collection. Leverage ratios. Debt-to-equity ratio. Total liabilities divided by shareholders' equity. 700,000 divided by 500,000 is equal to 1.4. Interpretation. The company uses 1.4 units of debt for every 1 unit of equity. Moderate leverage, not too risky, not too conservative. Interest coverage ratio. PBIT divided by finance cost. 200,000 divided by 40,000 is equal to 5 times. Interpretation: the company earns 5 times more than its interest expense. This indicates strong ability to service debt. Market ratios: earnings per share EPS. Net profit divided by number of shares. 150,000 divided by 100,000 is equal to 1.50 per share. This means each share earns 1.50 in profit. Price to earnings P/E ratio. Market price divided by EPS. 15 divided by 1.50 is equal to 10 times. Interpretation: investors are willing to pay 10 times the company's earnings. This suggests moderate market confidence. Final analysis summary. From all the ratios together: liquidity strong, profitability healthy, efficiency good, asset management, leverage controlled risk, market performance stable, valuation. This is how professional analysts interpret IFRS financial statements. Not by reading numbers, but by analyzing relationships. Now you've seen exactly how financial ratios are calculated step by step. Don't forget to like, subscribe, and share. See you in the next class.